We're going to move on to Javi. I would like to introduce Javi, who's our Chief Commercial Officer. Javi has come from 14 years at Goldman, and before that BGI, to head asset management at XBTO. So Javi, the stage is yours whenever you're ready.
You can hold it.
Sure.
Yeah.
Is that good?
Yeah.
Whoops. Excellent. All right. Well, thank you, guys. It's great to be here. I'm just going to start by saying something that it may sound a bit funny to you, but when I was actually preparing this presentation, I've been working all my life as a traditional quantitative investor for, technically, I finished school in 1998, so just going to give you a bit of my age here. But so I finished graduate school and I started as a quant analyst in 1998. And since then, I've been actually managing and investing assets in a quantitative basis. And I always thought, when I started investing in Bitcoin back in 2017, which was a very volatile ride, I always thought that, wow, why we don't do active management? And, you go safe, having an amazing, I would say, narrative and thesis about how to use BTC and, the case for Bitcoin and the investment case for Bitcoin, which I bought it into that narrative, for many, many years. But actually, what I think it is more interesting is that, what actually is the next step. And we hear him about, we have kind of becoming, during the pandemic, the traders, a lot of day hedge fund managers or personal hedge fund managers, everyone trying to kind of manage their own wealth, trading stocks, Robinhood, Wall Street bets, and all the things that you well know. But the idea is actually, how can we beat this proliferation or devaluation, or let's call it, increasing in supply of money. So what I do think it is a very important next phase in terms of crypto is, or crypto assets or digital assets, is what role active managers can actually play in this. And I'm going to try to make the case to you, and I say what's the crucial steps. And then there's 4 things, and there is a lot to unpack here, and I would love to probably come back at some point in time and kind of cover some more of these topics in more detail, because I know that everyone is hungry and want to go back home. But actually, there is a very important thing. And a lot of people, when I talked about it, crypto, the first thing, or Bitcoin, the first thing that the people mentioned to me, and actually we hear it from Saif at the end of his presentation, is saying is an incredibly high volatile asset class. Okay, so we start with that premise. But actually, coming from the angle of traditional finance, what I really want is a high volatility asset. Because high volatility means that they have opportunities, if in my insights to prove to be right, that I can actually make some money on. And some people will actually lose some money if their insights aren't correct, even myself. But it's actually an interesting future as opposed to basically a problem. The other thing is about correlation, okay? So, and we talk about how assets actually can move. And here, what I'm actually doing is moving a bit away from the case for Bitcoin and actually start thinking about that universe. And I know that we talk about, adoption was one of the questions about why the US is taking longer and so on, and, why the regulatory framework hasn't changed so fast and so on. But if you look at the growth of this sector, it's absolutely incredible. The amount of protocols that are launched a day, the amount of coins that we see in trading, the amount of venues and where we can actually trade is actually fascinating. And I think people don't give a lot of credit to what we see in here. And actually, that's my second point here. It is the microstructure of the market. And I don't know how familiar you are with microstructure of the market, but microstructure of the market, what we actually mean by this is a branch of finance, okay, of theory and finance, which actually study what sort of trading systems can actually be implemented to explode things that are actually happening on the market. And this market has a lot of interesting future. And in a quantitative basis, is a kind of a, the ideal fish tank for a quant. And lastly, I will actually kind of cover, probably a lot of the things that I think are incredibly important for traditional finance that it can be measured here. And a lot of people ask me the question when I joined last year XBTO, coming from that history of traditional finance, why would you do that? Why would you move into digital assets? And my usual answer that a lot of people probably have been hearing already was actually financial convergence. And one of the best topics here for financial convergence is that one, how traditional investment management can apply techniques into managing digital assets. And we will cover those in a second. And lastly, and very important, is there is still quite a lot of complexity around the system. And the reason is because it's actually quite new. I mean, everyone said, okay, we are at the early stages. We are at the early stages. And actually, I don't think that's a bad thing. But it's played to the strength of an active manager. Because there's a lot of people that perhaps don't want to become the hedge fund managers, okay, or they don't want to become the day traders. They don't really want to deal with the complexity of the assets and want to delegate that and pass that to an active manager. So let's try to unpack this, and I'm very happy to kind of take some of the questions at the end. So the first thing, the DNA. The DNA is high volatility and low correlation. Yeah, but that picture, to me, if you look at actually 5 years analyzed, and by the way, I took 5 years and the majority of the data that I'm using here, because if you actually go historically and go to 10 years as a safe actually show, or even further, the returns are so spectacular that a lot of the asset classes are going to look like just close to the zero. So I'm very happy to actually show even in a longer time series. But what actually happens, the things that you will expect, you will actually have BTC and other coins. I put the case of Ethereum at very high returns, but as well high volatility. But again, as I already talked about it, there is a lot of benefits from that. And then you actually have the majority of those asset classes. So trading here pretty much in a very low range of returns. I mean, again, some significant analyzed returns. In the case of S&P 500 and NASDAQ, that Safe already covered in his presentation. But equally, quite interesting set of volatility too. Now, on correlated returns, I want to spend a lot of that this time. A lot of people actually seeing this. But it's actually quite fascinating that we talk about gold and safe presentation. Well, BTC has kind of a similar sort of correlations relative to basically the S&P 500. Correlations here through the main equity markets. Of course, NASDAQ is going to exhibit the largest correlation. But if you actually see the correlation of BTC, and this is data from 2010, okay, probably now 14 years, you will actually see that correlation is incredibly low, and that implies that all those asset classes are equally going to have, with exception of gold, very low correlations to BTC. Now, I can tell you that correlations in some periods, because correlations are not constants, are basically variable, those correlations actually, in the case of BTC to major asset classes, can even become negative, okay? And that's very, very important. If you look at conditional correlations, you could actually see correlations of actually negative to the equity market. By the way, we just went through a period last week where correlation of BTC has been negative. Okay, we were trading down, and the majority of the market's actually going up or more or less stable. Okay, so it depends what you actually look at the sections of the market. Now, something that some people actually have talked about it, and I don't want to become too quanty here, but I'm actually quite interested as well when we think about volatility. So how the tails are quite interesting, and what is the distribution of returns of the asset class are important when you actually do active management. And what do I mean by this? And I have two interesting measures there. One is skewness, and the other one is kurtosis. And I'm sure a lot of you guys did econometrics sometime in uni, probably a long time ago, or in the high school. But basically, what we're actually talking about here is that the first one is how asymmetric or symmetric the curve is. In other words, is it prompted to actually have more negative returns or more positive returns, okay, or distribution of returns. And the other one is kurtosis, is that how extreme those events are. Okay, and if those streams are combined, if you combine the skewness and kurtosis, you can actually probably say, okay, you have a lot of extremes, and those extremes are to the negative side, which means they're larger tails and fatter tails, okay, which is the worst part of the equation. Well, if you look at the last 5 years, again, if you do those numbers, and I know an asset manager that actually have done that, the numbers are even better, okay? So what is classified? Well, you could actually see that everyone loves the S&P 500. Traditional assets, people invest into that as a class. They think it's a fantastic investment proposition. And the reason, because we know the returns that Save and myself showed, annualized returns actually beating inflation. But if you look at the distribution of that returns, it's actually quite, different. It actually has fatter tails and larger tails to the negative side. Okay? Now look at Bitcoin skewedness. It's technically, in that 5 years, is close to zero. What actually means it's very symmetric. We look at the S&P 500, it's minus 52. Look at the kurtosis, which means actually larger fat tails, and if you put that together, it's on the negative side. So, we talk about high volatility, but high volatility in the context of potentially being able to take opportunities is not a bad thing, okay? Especially when you look at the distribution of returns of BTC. Now, let's talk about the microstructure, okay? So, which I think it is very important. And this is kind of something that, as I've said before, I'm incredibly passionate about it. And I wish traditional finance have this, okay? Because, we kind of, the digital asset space or crypto space actually beat themselves very hard about, how things are basically not evolving as fast as they should be, but actually, the amount of progress and the amount of innovation has been absolutely outstanding. The first thing, 7 days, 24 hours a day markets, 7 days a week. I mean, who can actually do that in traditional finance? All right? Think about the instruments that we can currently trade in the digital assets. You have the ability to actually do derivatives. Well, actually, the derivatives market is probably even larger than the spot market. And I guess we go look here from there, but it can actually tell you that experience in terms of the open interest for BTC, for example. Okay, so there is plenty of opportunities that can actually be implemented that perhaps other asset classes and traditional finance are actually dreaming to be in that place. Okay, then the last one that I think is in terms of the venues. How many venues are there? And I put some numbers because it's very difficult to kind of get to the absolute numbers, but I can tell you centralized exchanges, if you look around, it's probably more than 500. If you look at DEXs, the centralized exchanges, even larger amount. So the amount of potential ability for you to trade and implement it in this market is fascinating. And then lastly, look at the things about market inefficiencies. And I put the case of the Korean inefficiency in here, which is actually the case of the kimchi, anomaly. By the way, the traditional finance markets are actually full of anomalies. Let's call it the end of demand effect. Let's call it, the rebalances of ETFs and, things like that we all in traditional finance love to trade. Well, crypto has quite a few of those. The Korean ones, the GBTC trade, the premiums here, the carry trade, you name it. Okay, so there is a lot of those anomalies that actually affect the market microstructure that can actually be very important for active managers to be able to exploit. But the one that I think it is even more interesting, and I think you all guys probably feel about this, is how fast assets are coming into the market. Okay? Now, I want to think about, I don't know how many of you listen to podcasts, how many of you try to kind of see new listings, who's actually the influencer that I have probably the majority of the highest hit ratio and recommending tokens and so on. But there is a massive amount of new potential opportunities. I'm not saying that they all have the same liquidity. I'm not saying that they all have the same depth, but the breadth and coming from a quant world is absolutely amazing. Okay, it's absolutely fantastic. And that combined with all the benefits that I've been talking in terms of microstructure of the market, it gives you a fundamental, great opportunity for an active manager to deliver significant returns. Now, what about the toolbox Okay, so what is actually in the toolbox that we can take from, let's call it traditional investment management or hedge fund, or let's call it investment manager in general, to crypto. So I put a few things, and there is a significant other points that I think are incredibly relevant. But I just actually took some of what I think are probably easy and quite interesting to explain, that you probably have to see some value. First one, trend following. Then we're talking about a bit of a derivative strategies, and since we mentioned the derivatives market and how large and depth is. And then we talk about how things fix in terms of portfolio construction, and very important techniques in terms of managing risk, which I think is incredibly relevant. Now, talk about trend. I mean, I'm sure a lot of you guys know about trend following, momentum driven, CTAs, okay? Now, one of the things that I always love about it, I used to manage 2 funds at Goldman for managed futures, is that I never got a question from any endowment or institutional investor pension plan or so about any of the trading systems, let's call it asset class, that I used to manage assets for. And I tell you, I have some very weird ones, okay? No one challenged me and said, well, is that a security? Is that an asset, or it isn't? And then you can call it electricity, you can call it, orange juice, you can call it, cattle, you can call it pork bellies, you can anything. As long there is a momentum play, as long as it's a trend, okay, you can monetize on that. And so the question about the ability to monetize was not based on a rational, but it's basically on the ability to look at a time series of returns and be able to infer price. Now, what is quite funny about digital assets is that when you said, okay, I'm going to trade BTC, I'm going to trade Ethereum, I'm going to trade Solana, I'm going to trade any particular coin, people actually ask you, well, but is that an asset, or what is it? I mean, at the end of the day, you have another dimension here is, well, if you really want to make money, okay, which is the point that Saif made at the end, well, it doesn't really matter as long as you have that microstructure of the market, I explained it before, working properly. As long as there is liquidity, I have the ability to have the instruments to implement and so on. But how do you do it is actually fundamental. And that is very important thing. So this is the kind of a, typical buy an asset and hold distribution of returns. Okay, well, you will make a loss if the market goes down. You will make a profit if it goes up. Okay, now what is actually interesting about CTAs, okay, or managed futures, or let's call it trend following managers, that I can actually identify when the trend is changing, and if the trend is changing, well, I don't need to kind of hold a long position. I can actually introduce something that is a short position. Then suddenly, the distribution of returns actually change by removing the long-only constraint. What that actually means, as a lot of you know, I have the ability to short those assets that are trading negatively, okay? So they have a downtrend. And that actually has a major effect. And again, a major effect not only in traditional finance, but actually in the digital market, okay, on the digital asset space. And that has a very, very important element, because if you think about it, and here I actually graphically show you the 30 days momentum, basic signal in terms of how a portfolio will actually be positioned, and BTC, you will actually see how, in function of the price, you will actually take long or short positions in BTC. Now think about expanding this signal, all right, plus another set of mean reversion signals, or different time series, or different, let's call it trend following signals, into a larger universe of assets. Think about having, let's call it, top 50 market cap coins, where some are going to trade positive, some are going to trade negatively, or some are going to all trade positively, depends sometimes, because, unconditional correlations become close to 1, all right? But what actually happens when they're all turned down? Okay, do you have to hold your coins, or you have to sell it all? No, you actually have the ability to make money here as well, okay? So very important. Now, how does that translate? And I usually talk to love to actually show things in terms of information ratio or sharps, I mean, whatever you want to kind of define it. But if you actually have the ability to hold a position in Ethereum or hold a long position in BTC versus having a trend following basically system, well, actually, your information ratios are significantly better, particularly in periods where BTC and Ethereum have a significant amount of volatility, periods where they actually suffer drawdowns that are quite significant, okay? And actually, in periods where the beta is having a ball, you still have 1.13, which is the case of 2023. Again, if you go back onto those numbers, it's even better because the returns are actually kind of spectacular. So now we talk about portfolio construction, and I think I love to kind of have the debate, and people think about how do you convince institutional managers and or let's call it pension plans and potential institutional investors get into crypto. Well, the best thing to do is just to kind of show the benefits of this. And again, I love to make the case for hard money, BTC, digital assets are the way forward. Basically disintermediate finance and all that, the theories that I deeply believe that is the way forward. But only in the case of actually introducing an asset class that has high volatility, so high expectations of potentially delivery returns with low movements or low correlation, can actually utilizing some of the techniques that we know that we have in traditional finance can improve very basic sort of investments that we know the majority of the people continue to utilize. So if you look at, for example, the performance of a 60-40 portfolio, okay, by adding only 20%, so just technically reduce to 80% the allocation into the 60-40 portfolio, you will actually double the returns, okay, again, through the same 5 years. And again, if you're looking at risk-adjusted basis, you may not want to actually have 20%, but the actually impact in terms of risk-adjusted basis is quite significant. And going to the point that even when you actually add something that is incredibly volatile, okay, so we have this, see it, well, you actually kind of reduce the drawdowns that you can experience. And the reason is because you combine the characteristics of the asset plus the ability to use techniques that so far you're not including in your portfolio. So for example, removing the loan-only constraint. So that's incredibly powerful when you actually construct portfolios. Now, I want to move quickly into something that probably is more attractive to holders of BTC, all right, or holders of digital assets. And the reason is that, well, I mean, why about using the derivatives market? So you can actually use the derivatives market in multiple different ways. One of them, which I think it is absolutely incredible, and that the digital asset space has managed to do, and it's something that in traditional finance hasn't worked out, but I tell you a secret why that, well, a secret, I'm sure a lot of people know about it, why things hasn't happened, is actually the introduction of perpetual swaps. Perpetual swaps, if you think about it, you go to traditional finance, you cannot find a perpetual swap in any instrument in traditional finance, all right? And why is the reason for that? Well, at least in kind of a liquidity, you probably can actually do it on an OTC basis, but they will probably likely to rip you off on the pricing. But why is that? Well, the reason is because the majority of the market is managed in a way where they benefit by having broker systems around the rollovers. So they actually need to roll the futures position. Now, crypto doesn't have that, okay? It doesn't have that problem. They don't have these tides, okay? So then you can actually have perpetual swaps that actually change in the funding rates on an hour basis, which is fascinating, all right? Which introduce a lot of efficiencies in terms of how the market trades. And that allows us to kind of have an incredibly useful set of derivatives markets as well. Now, one of the things that I wanted to show you is how you can benefit to basically outperform potentially or put your coins to work by systematically selling put options. And I'm showing the case of selling put options because I think probably we have a very good hit rate in terms of people holding BTC here. Okay, so we don't want to sell our BTCs, but we want to actually make some money with those BTCs. We want to put those BTCs to work. So one interesting way to do is either selling volatility, as we know is high, and take advantage of potentially selling volatility in levels that we would be attractive to buy BTC. In other words, to increase the exposure that we have in BTC. All right? So what actually happens to that is that actually you can generate some interesting out of performance. And technically, by taking some modest risk, and here what we actually have done is around 65% of the BTC that you're holding is just writing risk. So you're not fully collateralized, not fully leveraged in that regard. So by basically taking a modest risk, by selling options that they call it between 1 week and 1 month, and you can actually generate a yield of around 10% to 12% a year, even in periods where you have drawdowns. And how that looks, well, actually the maximum drawdown that you can have historically, covering all those incredibly painful periods that we saw, okay? You actually have the maximum drawdown that you experience with that strategy is close to 4%, 3.84. All right? So, which is quite interesting, because what? The reason that the asset class is actually skewed, going back to the distribution of returns, we all think the distribution of returns of BTC is skewed to the upside, which is a very interesting sort of distribution of returns. Anyway, so lastly, and not least, what about risk management? And I think we have some people that actually work here in risk management, but I think there is a lot of techniques that can actually be utilized from us in terms of covering risk management. But I think probably the more important that I would say to me here is about managing liquidity, is about managing hedging, is about reducing drawdowns, is about simulating scenarios that actually allows us to understand what potentially can have this basically, extreme movements that we can just plug it in the previous slides about 3 standard deviations. That actually, to be perfectly honest, as we prove in the numbers, is in less numbers that you could actually see when you manage assets like, for example, the S&P 500 or so. But the key element here is that, the challenge is that as we move into the microstructure that I described it, 24 hours, 7 days a week, well, you need to actually continue have monitoring. So you cannot be trading 7 days a week, 24 hours a day, without 24 hours, 7 days a week risk management. And that's the challenge that we presented here. But again, a challenge that can actually be overcome and with the right tools and the right skills. So now, I think, getting to the end, I think there's a few things that I actually feel that are quite interesting to me in the sense of why active managers can actually be incredibly helpful here. And the key for navigating complexity sometimes is very simple. It's outsourcing it, okay? And I think active managers can actually play a significant role here. And I mean, again, I put a few of them, but I think the more that the people always focuses on regulatory uncertainty. Okay, so you don't have to kind of get that trouble. You can outsource that to your investment manager, to your active managers who can navigate that for you. Cybersecurity, which is a problem for everyone here in this industry, and the amount of time, resources, and effort that the team put in terms of looking to cybersecurity, and I'm sure a lot of you actually concerned about it, is incredibly important. And why not to outsource that to a fiduciary basis? And I think that's an incredibly point. And lastly, something that people take, kind of simplicity and tend to not put a lot of attention into is reporting. And when I'm thinking about what people love about the ETF in the US, even when they have to pay a stiff fee, is actually outsourcing complexity. It's just the fact that, when you actually trade an ETF and you get your bank statement, it's one single line with an ISIN number that comes into, and you don't have to worry about it. It's all done for you, okay? Well, an active manager will actually do exactly the same, okay? And in a fund, you will actually have an ISIN number, you will actually have that outsourcing in terms of reporting, and if anything, you will actually have a significantly more transparency and details in terms of how that is reported. Anyway, so what are the key messages? I mean, again, I think if we move to the next stage in terms of crypto, I think the next step is not actually buying long an ETF and paying fees, because we all potentially can do that if we want to do it now in a buying BTC ourselves. I think it is actually exploiting this beautiful ecosystem that has been created that offer amazing anomalies for an active manager to exploit. And we can see that for the highball, the low correlations, the microstructure of the market, which is offering incredible set of opportunities. And actually, there is a fantastic case for outsourcing that to an investment manager. Anyway, that's all what I have to say. But thank you for having me. It's great to be here.
Thank you, Javi. Thank you, everyone, for being here, staying up late. I don't know if it's the food that's keeping you, but in any case, thanks for making the trip.
Take this off?
You came from Dubai. That brings the end to our sessions. We're going to be able to move next door, get some canapes, some drinks. Don't hesitate to speak to anyone in the team. We're also joined by Michael, who's our COO. We have Rishad, our CTO, sitting on the table here in the middle. Any questions you may have, and tomorrow you should also receive an email regarding the event. We would love your feedback, and you'll be able to fill a form if you want us to get in touch with you for any questions you may have. Once again, thanks for your presence. Wish you a good evening, and for those driving back to Dubai, obviously a safe drive. Thank you, everyone.